Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics, and welcome to those of you joining us online or on later video. I'm delighted to be convening this group for a presentation by Thomas M. Hoenig, the Vice Chairman of the Federal Deposit Insurance Corporation, Finding the Right Balance. We will have Dr. Hoenig, Vice Chairman Hoenig, former Federal Reserve Bank of Kansas City President Hoenig speak in a moment. I just want to acknowledge that a number of us have been big fans of Tom Hoenig going back a long way. One of the things that is so impressive when you look at Tom's career in public service, which included 38 years with the Federal Reserve before joining the FDIC board in April 2012, is that he is truly a principled conservative. And that is something that is in scarce supply, if I may say so, in Washington and in the world at the moment, and particularly on some of the big issues on which Tom has been forthright, not just his contributions on monetary policy and regulatory policy broadly as a member of the FOMC for 20 years, but also in his encouragement of deep thinking on especially too big to fail and some of the more sensitive and important aspects of bank regulation long before the crisis made it an issue. And as many of you know, our founding chairman, Pete Peterson, passed away last week. He is someone else I'm proud to say we were fans of and was a principled conservative. And where Tom, I think, also shares with Pete, although of course he did it in the public sector as opposed to Pete mostly in the private sector, is he put a real premium on research and independent thought, both his own, but his encouragement of that kind of work, Tom's encouragement of that kind of work at the Federal Reserve Bank of Kansas City, not only through the world-famous Jackson Hole conferences, but other efforts that he and his staff encouraged there, and continuing the good work at the FDIC, where he's currently vice chair, and has been president of the International Association of Deposit Insurers from 2015 to 2017. So the combination of speaking out on principle, of being consistent, of being evidence-based and relying on analysis, this is something I think we all hope for from our FDIC and our Federal Reserve and other economic officials. We've been very blessed in the US to have had many of them, but we should still appreciate them. And so I am very honored and pleased to have Tom Hoenig give his, as Fred said, valedictory speech as FDIC chair, FDIC vice chair, so sorry, at this time. Thank you, Tom.
Adam, thank you very much for this opportunity to speak kind of officially, perhaps for the last time, on several topics that are near and dear to me. And I really appreciate the turnout as well. So in giving this speech, I'm also going to date myself because I will remind everyone that over the 4th of July weekend in 1982, I was a very young officer in charge of lending at the Federal Reserve Bank of Kansas City. And our week had begun with the phone call from the panicked banker whose institution was experiencing a serious liquidity problem. The bank's funding sources, mostly deposits and upstream purchases of its energy loans, had lost confidence and were running. Then, reminiscent of the scenes from the Great Depression, lines had formed outside the bank as depositors demanded their money back, having heard rumors that the institution was in trouble. The Reserve Bank provided some replacement funding through its discount operations with the goal of buying time to determine whether the bank was solvent, and if so, whether it had sufficient collateral to lend against. Ultimately, the bank, Penn Square National Bank, met neither test. It had too little capital, and its assets were too distressed to offer any hope of survival. And the bank was closed that holiday weekend. Now, in the end, Penn Square, through its model of originate to distribute, contributed to one of the largest bank failures in U.S. history at that time, with the collapse of Continental Illinois National Bank. However, because Continental was then the fifth largest bank, and because numerous creditors would have taken significant losses if it had failed, regulators chose to bail it out. Thus began too big to fail as a modern policy option in the United States, at least. Now, I tell this story because it illustrates just how little some things have changed over the past 40 years. Events since then have included the S&L crisis, the Mexican peso crisis, the Asian financial crisis, the Russian financial crisis, and the failure of long-term capital management, and of course, the Great Recession and the Greek sovereign debt crisis. Each crisis has its own personality, of course, but what is often ignored is that the fundamental elements almost never change. These elements include a significant change in monetary policy, a crucial but inherently blunt instrument with far-reaching effects, a significant ramping up of leveraged assets, and management that displays a degree of confidence that repeatedly proves to be unjustified. On the other side, they too often also include supervisors who lack the confidence or are so convinced of management's talents that they fail to challenge questionable executive behavior. Another common element of most crises is in the aftermath is a new set of laws and regulation enacted with the intent to prevent any new crises. But memories are short, and with an improving economy, these laws and regulations, which early in the recovery are viewed as essential, are eventually recast as burdensome constraints that need to be eased or ended. And here we are again. After years of slow recovery, the economy is booming, and the call for regulatory relief is loud. This is the case despite changing monetary policy, increasingly volatile markets, increasing economic leverage, and changing risk profiles of some of our largest institutions. Still, standards of living are on the rise. Indeed, U.S. gross domestic product, some project, may approach 3%. While in flux, monetary and fiscal policies are accommodative. And you would expect that banking, and as you would expect, banking as an important component is also celebrating success, generating $165 billion of income in 2017, a near record. Considering this history, I want to take this opportunity as I step away from my role as FDIC in the FDIC to outline an approach for providing meaningful regulation relief without undermining the goal of assuring sound banking. The recommendations are founded on my confidence in the markets and their ability to deliver consistent economic growth. But there is a trade-off. Success requires that the rules which remain to assure that markets work include proven prudential standards that are enforced rigorously and complied with consistently over the industry. These standards include strong capital and wise constraints on the bank's reliance on government safety nets. With such a foundation in place, a number of costly administrative rules that create burden with little benefit can be removed or at least minimized. So today, the U.S. banking industry is better capitalized than that of most other major countries. Better capitalized banks lend more, promote economic growth and financial stability, and provide necessary confidence for the world to invest in them. That's our advantage. In fact, throughout the modern era, the United States has fostered and sustained a strong and highly influential banking system that is the envy of the world. But as banks' profits have grown, so have their appetites for risk and their dislike for regulations that constrain that appetite. They also are frustrated with rules that impose thousands of pages of administrative processes and unproductive costs onto their operations. The challenge is to eliminate those rules that impose a real administrative burden from those that set performance standards that allow properly gauged and priced risk onto the balance sheet. The former rules create needless barriers to bank competition and fall disproportionately on the different segments of the industry, while the long-proven prudential standards promote responsible performance and are key to meaningful deregulation. With that thought, I would ask the following questions. If one of the most common elements of recurring crises is excess leverage, if careful study and analysis by leading scholars suggest that a 15% equity to asset capital ratio significantly reduces the likelihood of failure with only the smallest of increases in lending costs, and if prior periods show that the market demands at least 10% capital or more when the government guarantee is not available, then why shouldn't a capital ratio of 10% equity to assets be the minimum standard for every bank wishing to operate in the United States? The answer I most often get in responding to that on stronger capital levels is that it raises the cost of capital and holds back economic growth. That's the standard reply. This view is repeated despite the many studies showing the opposite, that stronger bank capital contributes to stronger, more sustainable economic growth through the business cycle. And we know that when the business cycle shifts, and it will, and losses materialize, and they will, the absence of capital intensifies the downturn as the market suspects there's not sufficient capital to absorb the shock and worries about bank insolvency suddenly becoming too real. For example, going into the last crisis, the largest banks had about 3%, what we call tangible equity, and their losses were approaching 6%. In such circumstances, lenders must pull back. Liquidity dissipates at an accelerating pace, and fear gathers momentum. The magnitude of the shock spills over into the broader economy, where it can severely affect Main Street. Thus, it is not credible to base public policy on the assumption that unrestrained leverage accelerates economic growth without serious consequences for which ownership, not the public, should be accountable. Therefore, I caution strongly against eroding the post-capital standards that have contributed to the strength of U.S. banks and the long-awaited recovery for the U.S. economy. Weakening these standards will undermine the long-term resilience of not only the banking system, but the broader economy as well. For example, reducing the capital requirements of the most systemically important banks by excluding central bank reserves from the supplemental leverage ratio is a serious policy error. Measures on the table to do so would excuse primarily the custody bank business model from holding as much capital per asset as all other banks. What should be remembered is that custody banks are integral to the financial system, highly interconnected to the capital markets, and relied upon as safe havens in times of stress. How unfortunate during the last crisis these custody banks were seriously undercapitalized, and as confidence in them ebbed, the government found itself supporting them under emergency condition at levels reaching $60 to $90 billion per day. These trusted custodians must remain pillars of strength and should be retaining capital, not reducing it. There also are some efforts underway to try and relax the supplemental leverage ratio treatment of initial margin, because banks that act as clearing agent for their clients also guarantee their clients' exposures to the various clearinghouses without limit, removing initial margin from the exposure calculation of the supplemental leverage ratio ultimately shifts the burden of the guarantee onto the public. Lastly, it also concerns me that the U.S. regulatory agencies have joined the recent Basel Committee agreement that, according to some estimates, could remove as much as $145 billion of capital from the 8 largest banking firms. This is counterproductive. As I noted earlier, the U.S. banking system is stronger than that of other regions. Even with tangible equity only 6.5 or 6.6% of total assets plus fair value of derivatives, the market has come to rely most heavily on U.S. banks as they over their less well-capitalized foreign peers. Also, U.S. bank stocks are trading at a premium with an average price-to-book ratio of 1.4. In contrast, foreign banks trade on an average of below 1, a reflection of their lower capital and poorly priced asset risk. Should the U.S. banking agencies embrace the Basel standards, the reduction in private capital would necessarily be underwritten by the FDIC, the Federal Reserve, and then the taxpayer. As an example, one bank that received more than $100 billion of capital and liquidity support in the last financial crisis would be free to reduce capital by as much as 30% under the new accord. The United States should not engage in this race to the bottom. The second prudential standard that serves to mitigate mispriced risk in the financial system is the Volcker Rule. With the introduction and expansion of government safety nets, a side effect is the issue of moral hazard. For example, in the build-up to the last crisis, some banks relied on their insured status to engage in speculative proprietary trading and to organize hedge fund activity. When the crisis erupted, many of the assets had to be repurchased and brought on to their balance sheets, becoming, in effect, part of the bailout. That is why we have the Volcker Rule. Its purpose, appropriately, is to limit the use of deposit insurance to fund speculative trading and related activities, and that should not be compromised for any group of banks. With that said, the application of the Volcker Rule can be greatly simplified. Commercial banks should be free to enter into swaps and other derivatives to accommodate loan customers or hedge their own risk. And they should be free to buy and sell government securities and manage their day-to-day liquidity needs. No argument there. To accommodate this need, I suggest such activities be entitled to a presumption of compliance with zero additional reporting requirements, unless compelling evidence to the contrary is identified during the normal supervisory or examination process. With meaningful reporting relief, in effect, the burden would be eased. So rather than carve out exceptions, the Volcker Rule should continue to apply to all banks that benefit from deposit insurance. For the largest banks that engage in market making and trading, there should be an additional requirement that their CEOs attest in their confidence that procedures are in place and tested to assure compliance. But they should be able to do their business. With strong prudential standards in place, reflecting ownership's greater role in absorbing the risk its banks take on, the opportunity for regulatory relief for the largest firms increases. One candidate for such relief, in my opinion only, is the living will and its administrative process. The living will process, I think, is cumbersome. I think it's political, and I also think it can be misleading in terms of its implication for solving too big to fail. Annual preparation is costly to both bank and regulator. Once written, it provides little new information as it is submitted and then resubmitted each year. Most of what is learned is available through the examination process, if we wish, and the annual stress test, which is paramount. Eliminating or extending the reporting cycle would reduce bank and regulatory costs with access to information no less available for the most part. Unfortunately, given the size and scope of these banks' activities and their global reach, they remain too big to fail, regardless of their paper exercise. And the living will process may be having an unintended result of institutionalizing that effect. For example, with the encouragement from the regulators, the largest banking firms have adopted the single point of entry as a resolution strategy. This assumes that operating companies in the organization remain open through the crisis. Should it be necessary, these companies will have creditors, the so-called total loss absorbing capacity, TLAC, to recapitalize the bank, and if needed, they will have access to liquidity from the Treasury. However, this approach also has the effect of signaling that creditors of operating units will be able to get out of their positions early, which effectively is a bailout. The point is that the imposition of administrative rules and regulations that substitute for long-tested and more reliable prudential standards is poor. We can do with far fewer rules if we have a clear expectation that private ownership and substantial private capital, much higher than 6%, not taxpayer funding, will minimize the likelihood of crisis and its effect should it occur. To an important degree, community and regional banks are better positioned for regulatory relief than the largest banking firms. For example, regional commercial banks, even the biggest among them, do not engage in the same breadth of risk activities as so-called GSIBs. There are more than 5,600 banks in the United States, of which 35 are GSIBs or their affiliates. Unlike the GSIBs, the remaining banks have far less than 10% trading as a percent of their total assets, and most of them have 8% or more equity to assets. That's 95% of all U.S. commercial banks, by the way. For these banks, I have and others have suggested a substantial list of rules that should be reviewed or considered for elimination or simplification. The list includes the Basel capital calculation and compliance. It's a heavy burden on community banks. Liquidity rules. If you have sufficient capital, those become less of a paramount because they substitute for capital. And comprehensive capital analysis review for some of the smaller. It also includes rules already under legislative review, such as appraisal requirements for some banks, examination cycles, and even some consumer rules regarding, for example, the collection of HMDA data for the smaller banks, and of course the simplification of the Volcker Rule. Such changes represent real regulatory relief in terms of administrative burden. They would reduce the demand for banks' management time and strengthen the business of banking within their communities. This is the goal I believe we all seek, and these recommendations provide one possible and I think solid path towards achieving it. So let me finish by noting that the failure to better understand the nature and disparate effects of regulation on the industry will be to increase the cost of banking and encourage ever greater consolidation of that industry. Prudential standards strengthen performance, while administrative procedure rules raise new barriers, increase costs, and discriminate against banks that are less able to absorb those costs onto its balance sheet. As recently as 1984, the 10 largest banking firms held about 17% of industry assets. Today, the 8 U.S. GSIBs own only 20 banks, but control about 50% of bank assets. Moreover, when all of their financial activities, which include commercial and investment banking, their trust activities, their trading activities and derivatives, and their safekeeping activities are added together, the individual financial footprint, what they touch, individually exceeds US GDP of over 18 trillion. Their combined footprint exceeds world GDP of $75.5 trillion by nearly 40%. This consolidation story also suggests that too big to fail remains more a factor today than even in 2008, with the advent of that crisis, which serves to further guarantee more consolidation going forward. It's inevitable. A stronger banking industry relies on sufficient private capital to manage through the cycles of the economy, and it will be, as a result, a freer industry, where management can structure its balance sheet based on its strategic business model rather than government requirements that predefine how to allocate capital, how to use liquidity, and how resolutions should proceed. This would go a long way to returning some market discipline. Regulations could focus on prudential standards as they should, and less on large-scale government-mandated administrative exercises. I suspect we will always have a Federal Reserve Bank loan officer getting that dreaded phone call, where the banker on the other end is desperate for help in addressing liquidity. But I would prefer it be far less often than in recent years, and from an institution that really only needs help with liquidity, not with solvency, and not leading to bailout. Thank you all very much. It's been great to be part of the FDIC, and I think we have time for questions or whatever. Thank you.
So, Vice Chairman Hoenig, it's been great for all of us to have you be part of the FDIC, I think, as well. So, thank you for that.
Okay.
As you know, we here at Peterson Institute have been quite involved in some of these issues. You've been kind enough to comment on and attend some of our book launches. Most recently, as we're showing off today, we've got Maros Goldstein's book from last year on stress tests and Bill Klein's book from last year on the appropriate level of capital for banks, and obviously previous work by Simon Johnson and others. I guess what I want to pick up on, though, is, and this relates somewhat to Morris's work on stress tests. In addition to the rules being written down, there are obviously a great deal of room for interpretation in how stress tests, CCAR-like, get implemented, as well as when you mentioned prudential supervision to begin with. There seems to be an inherent need for some discretionary role in these things. How do you see that going forward? I mean, do you think that there should be more specification so that changing Federal Reserve officials or changing FDIC officials can't swing these tests in various directions? Or am I chasing after something that's either impossible to avoid or not relevant?
Excellent question. My thoughts on this are as follows. This is more of a critical issue right now with tangible capital around 6%, because your margin of error comes, and therefore you become obsessed with the models. And the models define how far the impact of your scenarios have. So there's a great debate on, is risk-based capital the floor, or is the leverage ratio the floor? And then you want to know what the parameters of the model are. So it becomes almost a game, if you will. I think the stress test can be very helpful, but not as a substitute for the level of capital you need in the first place. The market intuitively knows that you can just do fine at 6% when there's no problems. But when you do, then they take off. So if you had, number one, a much higher leverage requirement, and I don't think all the research we've seen is it doesn't cause a collapse in lending. It does, in fact, facilitate it through the cycle. So you're much better off. So what I've always said is, why don't you incorporate the stress test as part of the normal supervisory process in the exam? And it's a little bit of a value at risk kind of approach, but it has more substance in terms of the models you use. But you know you're using models, and they are going to be wrong. And your floor is the leverage ratio rather than one of your results of your so-called model and the stress you put against it. So having the standard high makes the error more tolerable in the model that you use. Having the standard low makes the error critical and the outcomes unpredictable. And that's where you end up, I think, in the wrong spot.
Thank you. Before I turn it over to our distinguished audience for on-the-record Q&A, one more question. I mean, you admirably focused your remarks on a big picture question of reducing the number of Federal Reserve loan officers who get that call. But part of the FDIC's mission is also, of course, about the individual savers and investors. And so there's legislation coming out about CDARS, not CCARs, CDARS, Certificate of Deposit Account Registry Service. And this is about allowing customers to spread out their deposits so that they are below the insurance cap. This is something I think a lot of us know about in our families, particularly with older savers.
Yep.
What do you see as coming in the legislative change in this area? What would you like to see or prevent in terms of change?
You know, it's a difficult topic because those who are promoting that are saying the largest banks are too big to fail, and therefore they're not going to lose there. So that gives them a competitive advantage over me. If that's the case, and if you truly believe it and the legislature follows that, then we should actually add a broader base for deposit insurance. I hate, you're going to raise a moral hazard issue.
Right.
But what you do now is you have a moral hazard issue, and you are allowing the rent seekers to capture the value of the deposit insurance, right, because they're brokering cross guarantees in a sense that the FDIC underwrites We underwrite completely for them. And guess what? They collect the rent. And I think that annoys me. It's the only way to say it.
So sorry, I got to push you a little bit for those of us who are not deep into CDARs. When you say this, so what is the actual proposal, and are you saying that you want to stop the proposal?
Well, so what you do is you basically, CDARs allow a broker to place it so in many places, and you can go back and forth with one another. And there's a fee they charge on that. And that's so that elderly can have $1 million and not have to worry about it, or not have to go to 4 different banks and so forth. But there's a fee to that the broker gets for giving them 100% deposit insurance. Now, does the broker now? So what they want is they don't want that to be identified as a broker deposits, so that they don't get quite the same premium charge. So that saves money for them. But we're still underwriting the same risk. So the risk is there, the amount we're insuring is there, and we're underwriting it. And they collect this nice fee, and you add that up. Small margin, big volume, it's a pretty nice return, nice rent return. So all I'm saying is decide what it is you want.
Right.
And because wouldn't it be better if you're going to do that to say, all right, we're going to give them deposit insurance and we're going to charge a higher premium? Let's say you had 250 and then you had 350, then you had $1 million. Wouldn't that be better? Because then at least the public is receiving the return and covering the risk through those premiums rather than it being skimmed out.
Got it. Thank you for the clear explanation. So let me open it up to comments or questions. There is a roving mic in front with Jessica. There's a standing mic in back. Please either stand up at the mic or wave to be recognized. Okay, at the mic, please.
Bill Klein here at the Institute. Thank you very much for your overview. I wonder if you would give us more chapter and verse on how you think the December agreement on Basel somehow weakened capital requirements for U.S. banks. I'm surprised by that. The major accomplishment there was to increase the output floors of the internal models, which was primarily a problem for the European banks, because for the U.S. banks, they were already subject to the floors by standard categories from the Collins Amendment in the Dodd-Frank bill. There was a bit of a nod to the notion of taking out the really secure stuff from your supplementary leverage ratio if you have a financial crisis, which sounded a little bit like the Treasury's taking out the deposits at central banks. But I'm surprised that the consequence of it would be a significant reduction in U.S. bank capital. Maybe I heard you wrong, but I wonder if you would elaborate on that perception.
Okay, so first of all, you're right. It does raise the floor several years out. And my experience with that is by the time those several years get here, those floors are adjusted, usually never up. And so that gives me pause. It's not something that takes place immediately, number one. And that's for Europe, and that's fine. For the U.S., we have stronger capital. Some people like to refer to it as gold plating. I like to refer to it as finally getting a little bit better, all right? So what the Basel does is it theoretically, and depending on what the agencies decide to do with the fine tuning and so forth, the international standard is 3%, and then you have your buffers and so forth. But if we were to comply with those buffers, and we can, then our standard comes down, even with the floor. Now, if we choose not to, then I would say, yeah, we're better off. But you have to choose not to. And my experience is, to your earlier question, depends on who's in charge. It's not a law. It's not a rule of law. It's an adjustable level that can go up or down, and the pressure will be to bring it down. All you have to do is witness. The very fact that we have legislation today to exempt custody banks, and they're saying, well, we can't compete. Well, they have the highest ROE of any in the industry. So it's how you use the argument to lever up again, And of course, it's when things are so good that leverage seems so wonderful, but it is a two-edged sword. And there will be a return down. And we will have losses. And we will have more confidence and less contagion effects if the capital levels are there and people have more confidence that one going down doesn't mean that five go down, which is, you put them all in a room and say you're going to take it regardless so we can fool someone. And I think that's counterproductive. It's not what we're about. And if we didn't have that implied or explicit guarantee, history would suggest the market would insist on much more capital. I mean, I got a kick out of watching the hedge fund saying, well, we may really take the risk and go 2-to-1 on our debt, on our leverage ratio. Not 20-to-1 or 30-to-1, but 2-to-1, and they were bragging about it. So we have a lot of leverage. And I'm not opposed to leverage. I'm opposed to excessive leverage that is allowed because of the safety net or the implied subsidy and explicit subsidy that we grant.
Okay. Next question, please. Really? He's the least controversial he's ever been? No, here, please.
I'm Morris Goldstein, PIIE retired. Tom, thank you for a terrific talk. It really was a great review. You mentioned a number of times in the talk that the 8 U.S. GSIBs have about 6.5% tangible capital ratios. But you also mentioned the efforts underway to take things out of the denominator of leverage ratios to sort of make them risk-weighted in some sense, with the intent of artificially boosting those capital ratios. And you were eloquent about why that's a bad idea. Nevertheless, it is going forward, whatever the evidence. What, if anything, can be done about that? Do we just wait for the next mess and then it gets fixed, or do you see any chance of changing that?
Well, I'm accused of being the eternal optimist, and we haven't passed the legislation yet. And I think that part of it is to make sure people understand that we are taking on risk, and someone will, when we have losses, it's never a question of whether they're losses. It's always a matter of who takes them. And the losses imply much more than whether or not the government doesn't put some money in and they somehow survive and they say, well, we paid it back. It matters all the peripheral effects of that. And I think that is what has to be explained. If they pass it, they pass it. And then if that happens, that will be only the first step. There'll be other efforts to further increase leverage or expand the value of the safety net to the subsidy to them. And I think there'll be consequences of that eventually we'll have to pay for. Someone will have to pay for. I really do.
Tom, thanks for coming. Fred Bergston here at the Institute. One of the perennial issues in the bank regulation question is the multiplicity of U.S. regulators. You've had more experience with that than most. What do you think about it at this point? How big a problem is it? Were the efforts to improve coordination via Dodd-Frank fruitful? Have they paid off yet to any positive extent? And to the extent there is still a problem from it, is there any prospect of doing something about it?
Well, it's a matter of how you allocate responsibilities in part. But first of all, let me say that I have argued that in a sense of knowledge and skills, each agency does have a legitimate case to make. They do make that case. The Fed, the liquidity provider, you have to have skills, not just during the crisis. Those skills aren't acquired overnight. And so they have to have people who can judge the institution. Even in long-term capital, which was outside, they had to have people who could go in and judge it, not just the banks. The FDIC, we insure them. I mean, we're insurers, so we want to know what the conditions are. And so we have skills to do that. And when you're going to give in terms of a resolution, you have to have skill sets there. They're not just acquired overnight. And the controller is part of the Treasury, and the Treasury is being a big player. So you can make a case. So the other issue is, by allocating rule writing to all three at once, you then make them kind of a legislative body. They have to come together and they have to negotiate and have to. Now, some would say that's fruitful, that you get, because of the shifting individuals, one being wanting to go this way, another going that way, you force compromise or combined judgment. And I remember a speech that Brooksley Born gave. Okay, she was the head of the CFTC, and she identified the issue of derivatives early on and was not well received for doing that. But she at least brought it up. Had she been subsumed into one of the other agencies at that time, it would have been you never would have heard of it. So there is benefit. Now, what are the costs? There are costs. I think you can reduce some of those by assigning certain responsibilities to each and then having the others do it, just like we do the CFPB now and so forth. But there are costs. But nothing like the cost of too little capital, all the things that I think we should be concentrating on, rather than, and let me tell you something now, but you know bureaucracies. So let's say we have one and it has 5 divisions. You think it's going to be a lot different? Anyone who's been in a big bureaucracy knows everyone has their, and it's less transparent, frankly. So I think there's trade-offs. That's not at the top of my list of issues at all.
Following up, though, on the plentitude of our agents of U.S. financial regulation, there have been visible cutbacks recently in the mandate and mission of the CFPB and of the Office of Financial Research at Treasury, which was supposed to support the FSOC. I understand that as you remain a sitting official, you may not wish to comment directly on the decisions.
Why, you think it'll shorten my term?
I'm hoping that's what you'll decide. Hey, no problem. But I mean, just in the spirit of what you were saying, I mean, will these cutbacks, in terms of the both public dialogue and what each brings to the table, what are the gaps you think might be created by this?
Well, I mean, it'll be marginal, right? Because you have, I mean, the Fed has a huge research group. We have a wonderful research group, so it'll be marginal. But I think some of the work that the Office of Research has done have been really outstanding, so I think we'll miss that. I also think the CFPB, in some ways, it's cut down, but in other ways, it's still pretty, I mean, its mission is clear and so forth. And that will get more attention over time because it's been controversial since the first. And I don't know, certainly I don't think it's going away. And so it will mature, it will change, but I don't think it's going away by any means. So I'm not too concerned about that.
Cool. At the back, Mike, please.
Victoria Guido with Politico. More on the topic of how many agencies there are. There's been a lot of talk about the Volcker Rule and whether there should be, a lead regulator for that. Do you have any concerns about making, it's most often mentioned the Fed, but just putting one regulator in charge of the Volcker Rule?
Well, it depends a little bit on what you mean by in charge. If you mean that you have one rule writer, I mean, that's not new. So I think you could live with that, especially where the FDIC, but I can understand where we're going with that. However, there should be a consultant role. So you have a rule writer, but they should consult, because look, the Fed's very appropriately is monetary policy and providing liquidity into a financial panic. Our role is to deposit insurance, protecting the fund, and making sure that there's a balance there as well. So we should have input into how you weaken it, because it is the deposit insurance that backs and lowers the cost of funding that allows for some pretty interesting speculative activities should you write that rule very loosely. And that's what really, we should have, I mean, whoever we are, we should have a voice in that. And if we were the rule writer, they should have a voice in that. But they can have the pen, or we can have the pen, as long as we do consult. And we don't do it just sub rosa. We write an official letter, here's our view, so that everyone's put on notice of what our concerns are. That might work, because otherwise you can get into this never have an answer because you never agree. We've seen some of the effects of that as well. So I don't have a problem with a single rule writer, with consultation, and identifying the issues that the other agency has, whether it's us or the Treasury or whomever.
Okay.
Thanks.
Thanks.
One may not be final, but one more thing of the many that you raised in your speech was you, by the by, expressed some skepticism at the importance or efficacy of living wills and TLAC, or at least the cost benefit. I was wondering if you could expand on that a bit. I mean, this is just to give you something to feed off of. As a relatively well-informed consumer of this kind of stuff, but not somebody who's in any way been involved in writing it, I would keep running into central bankers and people who would tell me, TLAC and living wills are like the resolution authority. That's the most important thing. And I would always sort of come out of it and say, if bankers have a long enough horizon and institutional loyalty to worry about their death, this wouldn't have been a problem in the first place. So I was kind of heartened to hear you say this may be a waste, but.
Well, I don't know if we have time for my answer, but let me just start. One of my fundamental concerns of the living will process is it gives the impression we've solved too big to fail. Mm-hmm. We have living wills, we solved too big to fail. No, we act on the individual living will under massive assumptions, no contagion effect, not everyone at once. Sounds good. Yep. So we're telling the public we've taken care of, they read it as we've taken care of too big to fail. We haven't. Too big to fail is getting more and more pronounced. You cannot have the footprint of these institutions and expect that you're going to have one of them fail without catastrophe. So that's number one. Number two, then we put in these other things. Now, single point of entry has, let me first talk about the single point of entry has this TLAC, which has debt, okay? Now, I've been an observer of debt for a long time. So the idea is you're going to put this debt in the parent, right, in the U.S. And this parent is going to have this debt, and it's going to be converted to equity. They're going to forgive and turn it to equity for the bank so that it's recapitalized immediately, assuming you have enough, right? But what about the process? So the market begins to see a problem. So you go into a recession, and the bank starts losing money. It's still capitalized, it's losing money. And now you have this debt. Debt has to be serviced or it's in default. It's not equity.
Right.
Equity, you say, I'm not paying you a dividend, tough.
Right.
Debt, you're now in default. So people begin to panic. Who holds this debt? Not only that, but they begin to sell it down and all these things. And you have, pretty soon you're going to hear about different groups who can't afford to lose it, just like Continental. And so now you have the supervisor. So I'm the supervisor, and I have to say, do I let them pay dividends so they don't go in default and start a panic with all the others? Because they all have TLAC out there. They're all in TLAC. Or do I say, no, I got to keep the stuff in the bank, so we calls it. Or I say, yes. Take the money out of the bank, put it over here in a broker-dealer who needs it. Holy cow, I'm cross-subsidizing with the insurance fund. Or I have it up here and I'm going to put it over. It is a prescription for confusion and panic. That's not what I consider a good plan. In fact, we had these trust preferred in the last crisis, and we outlawed the dang things. So I don't see the logic of TLAC. Single point of entry has a further effect because we over time everyone has kind of gone to that model. We've kind of encouraged it and others. And what it does is it homogenizes the industry. and raises barriers to entry because that's what you have to find. I don't think those are good outcomes. You know, equity is so much better. And, oh yeah, I know it's less expensive than it used to be, right, because of tax law. But it's still, you know, that's a reason. But what we've seen is you take equity and you lend it. And by not subsidizing it, you price the market better. You price the risk better. That's what markets are for. When you subsidize it and you allow the mispricing to continue, then you create all kinds of additional unintended consequences. And that's what we ought to be mindful of as we go forward. So that's why I have a real problem with it. I've looked at these. God, they're in, you know, deep, thousands of pages, hundreds of pages. They take a lot of work. They have a lot of thought going into them. That's fine, but like you say, whether you know, we could get this information by examination process, a lot of different ways. This is, I think, gives us a false sense of security.
Thank you. This will be the last question.
I'm Joe Gagnon here at the Peterson Institute. Vice Chairman Hoenig, you may remember, I think you were at the Federal Reserve and I was back when we instituted interest on reserves.
Yeah.
And at the time we thought that would be the sort of lowest rate in the economy and the base, and then on which other rates would be higher because it would be the overnight risk-free rate. Well, it turns out that that hasn't quite turned out the way we expected. The federal funds rate's been about 10 basis points lower than that. And it turns out the reason seems to be that the FDIC charges its deposit insurance fee now on the base of banks' assets, which includes reserves. So effectively, if a bank wants to get in the business of investing more in reserves, it has to pay a tax. And so it doesn't, the federal funds rate, they're not willing to offer the full 25 basis points to people who want to lend to them. Now, this may not be the biggest thing in the world, but it's led to a strange arbitrage where foreign banks who don't have to pay the FDIC fee because they don't take deposits in the U.S. can earn the interest on reserves, and they are able to borrow from people who can't get that money at a lower rate, and they get a risk-free arbitrage of about 10 basis points, which is a transfer to foreign and financial institutions of $1 to $2 billion every year for the past almost 10 years now. It seems to me a little odd that this is not an issue. I'm wondering, what do you think? Should we do something to change it, either who can get and not get interest on reserves, or maybe change the FDIC fee?
Well, no, on the FDIC charge. That's for risk. Quantitative easing had a big effect on that. There's lots of things that are affecting that. And I do think, I understand the question, and I understand kind of the challenge, but you know, you have all kinds of issues with payment of interest on reserves that have come up now. And I don't have the solution for it at the moment. I mean, you could stop paying interest on reserves. I know the chairman of the Fed was asked that question, and in terms of the margin and what we turn over, you've answered that and so forth. But I don't think it's the matter of equity. Let's figure out a way. Let's address it. The matter of whether it's impeding monetary policy, I don't think so. And I don't think we should. I think the FDIC subsidy is big enough as it is, so I wouldn't lower the fee.
Very good. All right. So again, please join me in thanking Vice Chairman Thomas Hoenig, not just for today's remarks. I'm sure there will be other celebrations, but our community's celebration of his 38 years of public service.
Thank you. Thank you all very much.